The rally in risk assets has stolen the spotlight since April, but now all eyes are turning to the US Treasury market, with Fed rate cut expectations sharply reduced. Rising real yields could also now be the next big story, and not just for Wall Street. Let's head to Adelaide now. We are joined by David Scott, APAC market analyst from StoneX. Great to see you, sir. Talk to us about the Fed rate cut bets. What's happening to them? Because we were expecting 4 last year, we didn't get 4. Then we're expecting 4 this year. What's going on?
Aaron, great to be back. And yes, thanks for reinforcing how bad the markets have been in predicting what the Fed's going to do over the course of a period of time. Right now, there's been a big unwind in rate cut bets. At one point in April, we had 5 cuts being priced in with a risk of a 6 coming through in 2025. Now, fast forward to today, we're sitting at 45 basis points. So that's less than 2 full 25 basis point cuts. And every single morning I seem to be waking up right now, and that number seems to be dwindling. There's a lot of investment banks coming out as well right now, and they're pushing back their forecast for the next cut from the Fed to come through in December. So there could be a long time between drinks, and that will have spillover effects to other central bank policy, including back home.
Yeah, well, what does it all mean for us back home, do you think? And when we have a look at this chart, what do you see?
This is the Fed funds futures curve for 2025. So this is giving you a rough estimate as to how much is being priced. And you can see there back to around 45 basis points of cuts. What it means for us in Australia is that whilst we're very likely still to go and get a rate cut from the RBA next week, beyond that, it's becoming increasingly unlikely that we'll see a big string of cuts coming through unless there's a crisis at this point in time. And put simply, looking at the economic data around the world, and especially back at home at the moment, there is no great need to go and rush in. There's still a lot of uncertainty. And whilst that persists and whilst the economic data is holding up pretty well, the RBA has shown that it's been a reluctant cutter. And I imagine that will probably come through as well. Big report coming out today with that jobs data.
Yes, looking forward to it. Talk to us about the US yields as well, this chart. How do you interpret, I guess, the recent jump in long end rates and what's fueling the rise in these yields specifically?
Yeah, so from left to right, you've got 2-year Treasury yields. In the centre, you've got 10-year benchmark yields, and then 30-year yields out on the right-hand side there. And you can see that pretty much we're now back to the kind of levels that we saw in the middle of April. Now, those of you who can remember back to what was going on right then, the Treasury market was getting absolutely smashed at that point in time, and there was a lot of concern about the US fiscal trajectory and how US policy was being handled, especially with partners abroad. Now we're back to those levels again. And whilst the Fed rate cut story has had a part of that increase that we've seen in those yields, particularly the short end of the curve, further out, there is something definitely going on. And that's really been seen in the real yield space, which are continuing to go and push higher again and move back towards those levels that we saw in April. What that basically means, real yields, you go and strip out the inflation expectations that markets have priced in for that period of time. And then you look at what's beyond that. So you've got a component with economic growth in there. But then you also have things like credit risk, which there shouldn't be for treasuries. And then you have things like uncertainty and policy uncertainty. And that's what's starting to go and kick it higher now. There's a lot of focus on what's going to happen with the US fiscal trajectory and concern that there's not going to be anything to go and plug the ballooning 6% of GDP deficits we're seeing coming through at the moment.
Why does it matter more than just inflation expectations? And you spoke about inflation there. We saw it come out from the US. It's tracking okay at the moment. And same in Australia too. It looks like they've done an okay job. But when we talk about the US yields and the surge in real US yields, why does it matter more than just the inflation expectations?
Mate, in a nutshell, it constricts activity. You're talking about 10-year yields, 30-year yields. That's the US mortgage market, which we know is probably the most important asset class in the world. And then that also goes and affects the cost of money abroad, including here in Australia. And it also influences the valuation of other assets because whether you believe it or not still at this point in time, treasuries are regarded as being a risk-free asset. So everything is a spread to what treasuries are. Everything's perceived to be riskier. And if you've seen that yields on those particular products are ratcheting higher, it means that the expected returns on other assets have to go and increase. Otherwise, you start getting valuation pressures. Hasn't come through just yet. We've had a really big rebound, particularly in those growthier names of the equity market. But the rise in yields is a concern if it continues.
All right, let's talk about Australia now. Obviously, all eyes on the RBA. There's been a lot of hope. I think the government have been hoping during the election campaign that there would be another cut and then more cuts. What's the expectation from where you sit?
Aaron, heading into the next week's meeting on Tuesday, we have fully priced. So a 25 basis point cut is in the price already. Where it comes into is what's going to happen beyond that. It would take an absolutely stellar jobs report to go and get the RBA to go and hold pat next week. But you can't rule it out because we know the RBA has been reluctant to go and cut in the past. But to me, it's going to be more so about what does the RBA signal next week beyond the May meeting? Because when we start talking about July, there's nothing really priced there. There's another one priced by late August, but there's not a lot to come through there. So it's going to come down to what happens with the labour market, because when you look at other forecasts the RBA has out there, inflation forecast, bang on target when it comes to that trim mean. When it comes to wage growth released yesterday, bang on target as well. So the swing factor for what the RBA is going to do domestically is going to be the labour market.
It's interesting. I think many of us who go out feel like we're living in a parallel universe to what the data says. It almost feels like what we accuse the Chinese of, that we see one thing and their data says another. I was at a pub last night, the only patron at the pub. Every day you pick up the paper and there's another major company that's gone bust. There's more companies losing jobs as well. It feels like what's happening in the real world is doom and gloom, yet the data, as we saw last time around, the surprising jobs data, seems to be telling a very different story. How can this be the case?
Mate, I'm pleased to see you keeping that pub in business, by the way. Look, when it comes to what
the amount of money that you have to pay for a Palmer these days, I think it just takes one person to keep them in business.
There we go. Yeah, look, I think what you're referring to, there's definitely a divergence in how things are performing between the private sector and then the public sector and those private sector companies that are linked to public sector demand. I think there's undeniable that you're seeing that that's kind of been what the driving force of growth has been for a long period of time. Hopefully that goes and flips around, but you need to go and have big reforms coming through and encourage people to go and spend. Unfortunately, the key to unlocking that is realistically tax cuts, and that looks like it's going to be a fair way off at this point in time, beyond what's already been announced by the government. So yeah, that what you're feeling and what other people are feeling out there is accurate. But of course, what you feel in your own world isn't necessarily what's coming across the entire economy.
Yeah, I mean, look, we're based in Victoria here, and the Victorian government has cut billions out of education the past few years, billions out of the justice system over the past few years. There's an article out today that the budget is going to be a horror budget with $22 billion in cuts. We've got nearly $190 billion in debt, which is an absolute record for a state in Australia and also for this state too. When the government starts cutting jobs, what's that usually a sign of?
Budgetary pressures, the bond market's usually saying something to them as well, but it is a risk at the moment because we need to go and have that transition over to the private sector. And if the private sector is not in ability to go and pick up the slack, which I'd argue at this point in time we're probably not, even though unemployment is still fairly low, then you run the risk that you start to go and see much slower growth. Of course, that comes with rate cut expectations likely to grow as well, but it also increases the risk that we could go and see a really pronounced slowdown. So if it's not in place, the conditions aren't right to go and do that handover, it does carry a risk.
Yeah, it's funny watching Trump overseas as announcing these massive deals, $100 billion here, $1 trillion there, and yet here we are talking about the doom and gloom that we've got. The bullish momentum in the ASX 200 is fading as well. What do you think we'll see over coming weeks? You mentioned about how it's already priced in a 0.25% rate cut, and the labour data may do something, but is there anything else that ASX watchers will be viewing for?
Look, purely from a technical perspective, which I tend to focus on when it comes to the actual index itself rather than individual stocks, it's really just telling me that we've seen this absolutely rip-snorting rally off the lows in April. But right now, what we're looking at is that we've priced in a lot of good news, and we priced in a lot of rate cuts as well, which have been dwindling as well. So when you look at what's been going on with the price action recently, there's no definitive price signal, but the momentum indicators that I look at, which the market tends to go and really kind of reflect at the moment, these big swings in either direction, we're definitely seeing a bit of a waning of that upward momentum. And when you go and put that into context of what we're talking about with fewer rate cuts being seen, potentially we could see a minor pullback. I don't think it's going to be anything more than that. It's going to take a real, something bad to go and up in the apple cart to go and really add to another big decline coming through. But we've run a very long way, very fast, and a lot of good news is priced in.
All right, we love good news. Hopefully it comes through. We'll talk to you again soon. Scotty, thank you.
Thanks for you.